Good afternoon, ladies and gentlemen. This is Jesse Colombo, Cyber Trading University's Forex and Futures instructor. And today's closing bell webinar, we have Barry Burns from Top Dog Trading. He's going to be teaching us how to trade with complete confidence day in and day out. So in this presentation, he's going to be discussing down-to-earth practical trading information that you can start using immediately after this webinar. And he's going to be showing you how to actually see the reality of which way the market's moving and likely to continue to move by ignoring the noise, and also to focus on clear, unambiguous signals. So he's going to be showing us 5 measurable energies in the market, and these energies measure what's actually happening in the market right now, not what could happen or what someone thinks may happen. So looking forward to that. But until then, that starts in about a half an hour. I'm going to be doing my market update and analysis. Pretty exciting day today. Things are finally starting to move. You can see right now I'm showing the S&P 500, my typical starting point. And we had an advance of the stock market today, U.S. stock market, partly because of technology shares and the strength in those shares, including Microsoft and Apple. And that was what was driving the market. Also, the dollar fell to a 4-month low today, so I'll be showing you all of that. Also, the bond market has stabilized a bit, and that's been causing fears in recent weeks. So that stabilization allowed the S&P 500 and other U.S. stock indices to rally a bit today. So I'm going to show you what I'm looking at right now. I've been showing this resistance level for months now. This is the prior highs that we saw that were marked back in late February and also in late April. You can see the market kept on trying to push. Couldn't do it, kept on selling off, formed a trading range, and now today is the start of an early breakout. It's attempting to break out. It was a solid up day. It closed nominally above that resistance level, just about 2 points above that resistance level. So that's a good start, but I want to see more. Normally when I look for a breakout, I want to see a candle like this that has a good 50% of its body above that resistance level. So maybe we'll get that tomorrow, further push, and then if that happens, we can see further rally, assuming it happens on high volume. That confirms, that basically the smart money and institutional traders are putting their money where their mouth is and accumulating shares. So that's what I'm watching for. But good sign so far. Could be an opportunity to go long. As usual, I'm not giving investment advice, not telling you to do anything, but that's what you want to see. And I want to see if it's going to follow through tomorrow or early next week. So just keep on watching that. Let's take a look at the Dow. And even if you don't trade stock futures or ETFs, other ways of playing it are large cap stocks that basically are highly correlated with the broad markets. Here's the Dow. You can see it was in a wedge for the past few months. Pushed right above that level. This is looking stronger than the S&P 500 is, but in order to really further confirm it, I want to see it break that March 1st high. So that's just under 18,300. It's actually 18,280 is the level I'm watching. So I want to see the Dow clear that very decisively over the next few days, next few trading sessions on high volume. That's what I'm watching. But for those who are aggressive, it could be a good opportunity to get in early on. Maybe, let's say, if you intend to invest a position, maybe you can invest half of it now or trade, as far as long position, invest half of it now and then the other half when it breaks above that second resistance level of 18,280. But if it tries to rise above and then drops back below, giving a false breakout, then I would certainly cut my losses in that scenario. Let's take a look at the NASDAQ 100. That's what the QQQ is based on, the popular tech stock ETF. Well, it's not a tech stock ETF, it's the NASDAQ ETF, but it's heavily weighted toward tech. And I've been watching that resistance level just around 4,480, and you can see several highs here that right around that level kept on trying to push. It also had a false breakout a couple weeks ago, Tried to rise above, but the other indices didn't follow through, and it failed. So it's trying again. So let's see if 1, 2, 3, 4, the fifth time's a charm. Let's see if that happens. But really needs to have a solid follow through. See what the Japanese Nikkei is doing now. Not as much of a rise. Maybe in tonight's trading session, there Friday, we could possibly see a follow through in that. But 1 second. Not really seeing any real clear signal here either way, but I'm watching this support. Just want to make sure that this doesn't end up being a bearish head and shoulders pattern. So this is the neckline I'm watching right around 19,000. If it let's say were to break below that, that could be concerning because this could end up being a top. But I just want to see which way it goes. It tends to trade similar to the U.S. market, but it has its own nuances that drive it, including the Japanese yen, etc. So just keep on watching that support, and I'd like to see if it can break above the recent highs. Let's say if all the global markets follow through to the upside. Let's take a look at the dollar. Big moves happening in the dollar. Getting pretty exciting here for us forex and futures folks. I've been watching that support level at 11,750 in this US dollar index. And that was the lows that we saw in January and February. And I was watching that. I was showing for weeks or a couple weeks that it looked like the dollar index was forming a bearish pennant pattern. And that's exactly what happened. So it broke down, and that broke below that support. So that's not a good sign for the dollar. You know, for dollar bulls, it really doesn't matter either way. For traders, because you can go long and short. But that's typically bullish for non-US non-US stocks, non-US currencies and commodities. So just want to see if that's going to keep on heading down, but certainly we're seeing a breakdown here. Let's take a look at the euro. It's breaking out. Like I said yesterday, I said if the dollar breaks down, you're going to see the euro break out from this pennant or this recent consolidation. Actually looks like a flag type of pattern. So there we go. You can see pushed right above. It's above 1.14. It was a key psychological level I mentioned yesterday. So as long as the dollar keeps on breaking down, you should see further bullish action in the euro. So it looks like it could be rising in a channel formation right now. So I'll be watching that. The next hurdle it has to clear is 1.15. It's a major psychological number because it's a round number. And it also marks the highs that we saw in early February and also mid-January. Just going to look through the other currency pairs. Not really seeing much with the dollar yen yet. Still in that wedge. It's probably not going to move big until there's a breakout either way. Breakdown or breakout from this longer term wedge that you can see on weekly. So I've been watching this for a possible setup. But really, it's just very calm right now. Probably the calm before the storm. All right. See the British pound. British pound keeps on rallying. No surprise. The dollar broke down, and it's pushing non-U.S. currencies up. Here's the dollar Canadian. I'm still watching this little flag type of consolidation pattern. If there's further dollar weakness, then you're probably going to see this breakdown soon. Could be a good short opportunity. And I'm not recommending you do this, but just saying this from a technical perspective, that if the dollar keeps on weakening and oil keeps on rising, that could strengthen the Canadian dollar against the US dollar, and that would cause this chart to break down. Could be a good short opportunity below there, below 1.195. All right, let's see. Australian dollar. Pull back a bit today, but still in a confirmed uptrend because the U.S. dollar is breaking down and because iron ore has been rebounding, and that's been helping the Australian dollar to rebound itself. All right, let's see what else. Let's take a look at oil. All right, so you can see oil's above that. It's quite a bit above that $54 support I've been showing for several months. still in that rising channel type of pattern. It's been struggling right around 60, key psychological level. Even though the dollar's been breaking down, and that's typically bullish for commodities, there are other factors that also affect commodities, including obviously supply and demand and fundamentals. And in this case, what's hampering oil a bit here is the massive glut of oil. There's just so much oil out there. And the only reason why we had a rally in the last 2 months is because the dollar fell. If the dollar had gone up or even stayed flat from where it was at its peak, I think it was in February, we would not have seen this oil rally. This oil rally is 100% dollar driven, or 95% dollar driven, because the fundamentals of oil are horrible. We have a massive glut of oil, and it shows no signs of slowing down. The shale oil companies in the U.S. and other oil companies have a lot of debt, and they have to keep on pumping oil in order to generate revenues to cover their debt. So they really can't cut down as much as they would probably like to. And that's why supply is so high right now, and why it just shows no signs of letting up, really. But I'm just watching this uptrend line, and this is probably going to determine the next move. Looks like it could be forming a pennant type of consolidation. So if it breaks above, then we'll see further bullish action. If it breaks down, then we'll probably see a correction, maybe down to 54, and then we'll see what it does from there. So I'm not predicting, I'm just reacting. Let's take a look at gold. I know Lori and many others, including myself, are big fans of watching the gold market. So I've been showing this 1180 support, and I've been saying that there's likely to be a breakout if the dollar breaks down. So I've been showing the 1220 resistance level. Gold surged yesterday. Actually, for the past 3 days, yesterday was a huge move because of the dollar breakdown, and they trade inversely. And now you can see gold tried to rally above that 1220 resistance level, couldn't do it today, and pretty much closed right at that level. So I want to see if there's going to be a follow-through to the upside if there's further weakness in the dollar. So I'll be watching that. So, all right, so I have to do a audio test with our presenter, and we'll be back on in about 15 minutes. And that's when Barry Burns is going to be teaching us how to trade with complete confidence day in and day out. So, and if you have any questions for me, trading questions, want to just chat trading, or interested in doing private coaching on a variety of trading styles, just shoot me an email at jesse@ctutrading.com. And I love to help. So, all right, I'll be back in about 15 minutes. Talk to you later, folks. Good afternoon, ladies and gentlemen. This is Jesse Colombo, Cyber Trading University's Forex and Futures instructor, and I'm very excited to have Barry Burns on with us today. He's going to be teaching us how to trade with complete confidence day in and day out. So he's going to be showing us down-to-earth practical trading information that you can start using immediately after this webinar. And he's also going to be teaching you how to see the reality of which way the market's moving and is likely to continue to move, so that you can ignore the noise and focus on clear, unambiguous signals. So he's going to be showing us 5 measurable energies in the market. And these energies measure what is happening in the market right now, not what could happen or what someone thinks may happen. So I'm looking forward to it. Thank you so much. And definitely be watching it with great interest, Barry.
All right, thank you for that nice introduction, and I'm happy to be here, thrilled to be here actually. I was in the Cyber Trading University trading room this morning, and really for us Angelinos here, I'm in Los Angeles, California, and got up at 5 o'clock in the morning to follow you guys, and it was great. It was really good. It was a great experience, and I saw people making money. And of course, I have a tremendous respect for Fausto and all that he's done and accomplished in his book and his championships and his expertise. So it's really an honor for me to be here, and I refer people to him when they're interested in doing what he's doing, which I highly endorse. And I'm here to share with you what I do. So without further ado, let's go ahead and get into it, and I'll share that with everybody. So, yes, my name is Dr. Barry Burns. I'm the founder of Top Dog Trading. I'm the author of a book called Trend Trading for Dummies, part of the famous Dummies series of books I'm sure you're familiar with. They approached me about a year and a half ago and asked me to write this book for them. And so little did I know how much work that was going to be, but they're a great organization. Boy, those people really know what they're doing, and I learned a lot by doing it, and also poured decades of experience into the book. So I'm really proud how it turned out, and it was worth the work, and highly recommend it for you as well. I receive Reader's Choice Awards from Stocks and Commodities Magazine every year since I've been nominated. I've been featured in other books as well, such as A Complete Guide to Investing in Derivatives. I do a lot with derivatives. I work with a lot of other trading companies, brokers, software firms, exchanges, training their traders, Ninja Trader, the CME Group, eSignal, Metastock. Metastock, we worked together and collaborated and just came out with a software toolkit for their Metastock charting program, and that just came out a couple of months ago as well, so that is also very new. Great people to work with. I've done training for the Eurex Exchange, high profit candlestick patterns. I use candlesticks, and that's actually my company. And so then, as part of that, I was able to get featured in the book using candlestick charting. And so that was an exciting experience to work with them as well. So I got featured in there. I'm getting people say the sound needs to increase. Okay, how's it now? Let's try this. Sound much better? Okay, great, good. It's typical. Okay. All right, very good. Thank you for telling me that. Happy to do that. Like to know that. That's important. We want to make sure that everybody can hear. Otherwise, I don't want to keep talking if people can't hear me, obviously. So thanks for letting me know that. Okay, so important disclaimers. This is very, very important slide. Maybe one of the most important slides of all, even though this isn't the reason that you came. Because we need to make the person who is dearest to our hearts, the person who we all love and adore, the person who cares about us more than anyone in the world, the most spiritual, kind, gentle, warm-hearted, puppy-loving person in the world. Got to make them happy. And, of course, it goes without saying, I'm talking about our lawyer. So let's talk seriously about this, though, for a moment, because trading is not suitable for all people. Some markets are leveraged. You got to be very careful of leverage. Leverage can be wonderful and helping you make more money with less money. On the other hand, it is a double-edged sword and can really, really hurt you if you're not careful with that. So talk to your broker. Ask them to give you your maximum risk exposure. Learn about risk management, money management. These things are absolutely critical. They're at the core of what professional traders do. So many traders think that, oh, they're just looking for the next magical indicator or price pattern or something. No, all the professional traders that I've worked with, those things were not primary. Primary was also always self-discipline, managing yourself, managing your money, and managing your risk. Please only use funds that you can afford to lose. We call that discretionary money. Never use money for trading that you need to make your house payment, your car payment, for your retirement, your kids' college education, things like that. Trading's too risky for that. All information in this presentation is for educational purposes only. I'm not going to be giving any specific buy or sell advice. No recommendations or endorsements to buy or sell any specific investment. The use of the information is at your own risk for general purposes only, and we assume no responsibility or liability for errors or omissions. Okay, so there we go. My lawyer is not here, but if he was, I'm sure he would be, well, I was going to say he'd be smiling from ear to ear, but actually my lawyer never smiles, so yeah. He'd be mildly happy. He would mildly approve. So over the years, I've actually been trading since, I started learning to trade, I should say. I started learning to trade when I was 8 years old. My dad was a stock trader and was passionate about it. And so I started learning from him, and I'm now 56. So I've um, been around a little while. And so, yes, I've seen a lot of things come and go over those years, and the market has changed tremendously. The way they trade, the way markets move. I mean, there's a lot that's still the same. People are the same, but with the advent of computerized trading, boy, things really, really changed tremendously. Technology. So anyway, one of the things that I do periodically is about once a year, I send questionnaires out. And I'm going to do that here too. Not send the questionnaire out, but I'm going to ask you a question and invite you guys to answer this question in the chat box. Be interested to see your answer. And we're just going to do one question off of the survey today, and that is this. What's your most common trading problem, struggle, or frustration? What do you guys struggle with? And this will actually help me to customize the presentation for you today. This is not just a survey for survey's sake, because I've already surveyed tens of thousands of people and gotten answers. And I'm going to share those answers with you here in a minute, by the way, so that you'll know what other people said. But I just can customize my presentation based on your answers. So go ahead and into the chat box there, type your answers, because what I can do, I'm not going to change my whole presentation, obviously, but what I can do is spend more time on those issues that are of concern to you. And if I have a slide or a topic that's not of concern to people, then I'll just either spend less time on that slide or even skip the slide altogether. That way I make sure that I'm focusing on what you guys really want to learn and know today, so I can be most helpful to you. Okay, so I think, yeah, you guys can all see the chat there, so you can see the answers coming in. Sometimes in these forms you can or can't, but this one I know you can. So entries on the open, yes, that's a challenging one sometimes. Entries and exits, timing entry and exits, okay. Well, that seems to be a common one. Bailing out a loser only to see it take off. Oh, okay, good one. Yeah, I know. When I buy, it goes down. When I sell, it just goes up. Okay, yeah, James, that's a problem, definitely. You're not alone in that, by the way, so don't feel too bad. Fortunately, there's solutions to these things. Roman, managing losing trades. Yes, very important. Steve, oh, I like Steve's answer. Patient for the right setup. That used to be one of my big problems, by the way. I'll just treat you like my priest and confess that over trading was one of the things I had to personally struggle with for a long, long time. Donald, entries and exits. Wow, that seems to be the big one here today. Don't know which stock to trade and which way it's going. Entering a trade, when to get out of a winner, very important. How to know when you're entering a sideways market, frustrations, staying in a winning trade, setting stop loss, all of the above. Wow. Okay, well, you're at the right place then. And trend trading breakouts that fail repeatedly. Yeah, you know, that's one of the things that we're seeing more and more now is failed breakouts. Failed breakouts, yeah, that's a common pattern. So, okay, well, very good. Thank you guys for participating. I really appreciate that. It makes it more fun for me when it's a two-way conversation. So let me share with you, as I promised, what some of the most common answers were that have come in over the years. Literally tens of thousands of traders now have taken this survey. And on this particular question, here are the most common answers. I think we got the top 5 here. Number 1, they would say, well, I enter the market, let's say they buy. Then, right after they get filled, the market turns around and takes out their stop. Then, right after their stop is taken out, guess what? Market turns right around and goes back in the original direction of their trade. And I noticed that a couple of people actually mentioned that one. So there you go. There you go. All right. In fact, by the way, I'll just make a quick comment here. One of my trainers, one of my coaches, and I've had many mentors over the years, by the way, who have all different approaches, and learned something good from every single one of them. But one of them was a floor trader at the Chicago Mercantile Exchange back in its heyday, which is a long time ago, of course. And he said, Barry, he said, retailers are usually right, but at the wrong time. And this is what he meant by it. He said, like, they can see a trend, but they don't get in at the opportune time, so they end up getting stopped out even though they were trading in the right direction of the market overall. So yes, that's an issue of timing, and I'll talk about timing in your entries today. Also, getting out of big moves too soon, and so not making the huge profits. I saw a lot of you mention that one. That was a common one. Getting stopped out too often, not knowing exactly where to place your stops, or just taking a bad setup and so you get stopped out. Not knowing the best place to exit. Again, a lot of you mentioned that one. A fifth one is trading a trend that doesn't follow through. And again, several of you mentioned that. As soon as you get in, the market goes in the opposite direction. That's pretty much a translation or a paraphrase of what that means. So a couple things to get out of this exercise, and I love doing these exercises with live participants like this, because here's one thing I want you to get out of this. Notice that with a survey of tens of thousands of people, that's pretty representative, right, over the years, too. And so what it means is your problems are not unique. I don't want you to feel too bad about the struggles that you're having, because you're not the only one. These are common issues, common struggles that really all of us deal with to some extent or another. Now, some of us deal with certain ones more than others, but these are common frustrations of many traders. So you're not alone. You're not unique. There's nothing wrong with you. You're not uniquely bad. These are just common issues, and there are answers. And I've actually built my presentation around these 5 problems today. So if you're having any problems with these, you're at the right place, because that's what this is about today. So I'm going to share with you an overview of my trading methodology. Pretty much going to give you the whole thing. I'm going to lay out the outline of it at least. And it's a very simple trading method. Another thing I learned as I went from mentor to mentor and coach to coach over the years was that inevitably they would always have me simplify my trading. And we seem to have, as human beings, this natural inclination to make things more complicated than they have to be. We're always looking for more stuff, more tricks, more gadgets, more indicators, more technology, whatever. Now, some of that is very, very helpful. For example, if you're a day trader, you definitely want the best technology. Absolutely. That's critical. But there's so many of the stuff out there. There's so many things available in the trading world. By the way, that was also one of the most common answers was information overwhelm. Nobody mentioned that today. But that was another common answer from the survey, and it consistently is year after year. Information overload. People feeling overwhelmed by all the information out there. And a variation of that was there's so many different approaches to trading. They didn't know, which one is right or which one's wrong. Well, I'm here to tell you that I know after all these years, I've met a lot of traders. A lot of them are good friends of mine now. And there's more than one way to groom a cat. So I've got a lot of friends who trade, and they may trade things that I'm not comfortable with personally. It just doesn't fit my personality, but they're still making money. So God bless them and the horse they rode in on. If they're making money, then I don't argue with them. So here's what I've settled on. Through all the years, I found that actually I made more money by simplifying my trading. Because there's, Einstein once said, I like this quote from Einstein. He said, make everything as simple as possible, but no simpler. I love that. Now, obviously, he wasn't talking about trading, but I think it applies to trading as well. So we want to make everything as simple as possible so that we avoid that sense of overwhelm, and so that our mind can function clearly, and that clarity is absolutely critical to trading, because the confused mind cannot act. So especially when we're day trading, you've got to be able to make quick decisions. And therefore, we can't entertain too much information. So we want to make everything as simple as possible. Now, the other side of that quote is, but no simpler. That's because we want to create a probability scenario that favors us. And to create a probability scenario that favors us, we need a certain amount of data or a certain number of variables in order to create that probability scenario. All right, so I've whittled it down to 5. That's my number. That's the number I use. I use 5 variables. And that's all I do is I look at these 5 what I call energies in the market. Now, what do I mean by the word energies? Energies, I'm very practical, just down to earth. I'm not into a lot of theory or, I won't say any specifics because I don't want to offend anybody who might be into something. And by the way, again, as long as people are making money, I'm saying that's great. That's fantastic. But for me, I'm just a very practical, down-to-earth kind of guy. So when I refer to energies, I'm talking about the energy of money. The actual money flow, the money that's flowing in and out of the market. That's the energy. When I was on the floor of the CME, you can feel the energy. When you just stand on that floor, and even if you've had like a squawk box service or something like that, you get a sense of that audibly. There's even a more visceral experience when you're literally physically on the floor. Then you see the people, you can see who the orders are coming through. Obviously, they try to hide all of that, and they actually do a pretty darn good job of it because they don't want you to know who's bringing in these orders. But there's still this energy there, and that's what gave me this, is why I use this term. So I tried to translate that energy from the floor to the screen as well as we can. There's no perfect translation of that. And by the way, just because there's a lot of energy doesn't mean anything's sustainable. A rumor or gossip could come in, and the market could go crazy for like 30 seconds. And then all of a sudden, because people will just have a knee-jerk reaction to a headline. And then all of a sudden you read paragraph 1 of the article or the announcement, and it's like, oh, well, that was BS. That doesn't mean anything. And the markets all, go back and revert to the mean of where they were before. So you have to be careful with this. You have to be a little elegant with it and not just trade knee-jerk reactions to things like that. Although some people do, and some people make a lot of money, but they're in and out in seconds, or even less, right? High-frequency trading, etc. Okay, so what I do is I call my approach to trading a methodology, and I'm very intentional about everything I do, so that word choice is also very intentional. And the reason I choose methodology is because my trading is very methodical, rule-based, very objective. I'm not a discretionary trader. So what are these 5 energies? Let's just list them, and then we'll explain them. So, and by the way, because I'm so methodical, because I've got to keep my mind orderly and focused and concentrated and confident, part of what helps me do that is I can't manage the markets, right? I can't move the markets. I'm not a whale. So I'm a guy out here, a screen trader, and I do pretty well, and I've got pretty good sized account, but I'm not an institution. I'm not a pension. So what I've got to do is just go with the flow of the energies. And so I can't move the market. I can't manage the market. The market's going to do what it's going to do. But what I have to do is manage myself. And part of managing myself is managing the process in my brain. So I'm a technical analyst, and when I watch the charts, I always look at them in the same order. So again, orderly. It's part of being methodical. So the first thing I look at on a chart is the direction of the market, if there is a clear direction. And by the way, it's got to be clear. So is the market moving up or down? What's the trend, if there is one? Number 2, that's momentum. Energy number 2 is momentum, and that refers to the strength of the trend. Now, this is why I don't consider myself just a trend trader. Trends are great, and I will trade them when appropriate, but I don't define myself as a trend trader because I trade other things. Even if there's not a clear trend in the market, I might still take a different type of trade. So, for example, there's momentum trades. But today let's just talk about trend trading. So a trend, and by the way, this answers one of those questions when people say, well, I saw the trend in the market, and it was up, it was clearly up, and I bought, and then the market all of a sudden turned against me. Okay, 2 issues there. Number 1 is timing. Has anybody heard the phrase? Well, I'm sure everybody has heard this phrase. This is like the most common phrase in trading. The trend is your friend until what? The trend is your friend until... Who can finish that sentence? I'm sure probably most people in this room can. You guys are all pretty experienced here, being in this chat room. Yeah, that's right. The trend is your friend until the end. is the abbreviated way of saying that. And the reason for that saying is it's really a teaching moment to indicate that the high probability opportunity for a trend is at the beginning. The longer you wait, the probabilities go down. So I will only enter a trend early in a new trend. And by the way, again, early has a very clear definition. It means the first two cycle lows in an uptrend. And when we get extended in the trend, I will look forward to weaken, and I may even fade the trend at that point. I may. So when we have a trend, that's number one. When do you get in early? Early is the answer. Late, no. And there's a very market logic. I always refer to market logic. Market logic means the participants, the people, the computer programming, all that stuff, has a logic to it in its own mind. And there's a reason things happen. So one of the reasons that trends tend, not always, I've seen some big long trends, we all have, but in general, we can't trade the exception, we have to trade the rule. In general, the reason that it's better to get in early in a new trend is because the longer that trend goes on, people start thinking, oh my gosh, I'm late to this trend, I'm too late to the market, and so less participants come in, and therefore there's less fuel to keep it moving. So that's the market logic reason why that happens. Now, I also need not only timing, because some trends are short-lived, or it looks like it's starting a trend and then it never actually develops. So the other thing is the strength of that trend, and that's momentum. So I won't trade in the direction of a trend unless it has energy number two, momentum behind it. I'll only trade strong trends, not weak trends. Now, the interesting thing here is trend is, by definition, always lagging. In other words, on the hard red edge of the screen where we all have to trade, trend only tells you what's been happening up to this snapshot in time. As traders, what we really care about is what's going to happen after we get in. Will it make another higher high after I get in? If it does at least that, then I can adjust my cost position, I can maybe take a little profit off the table, I can move my stop, whatever. I'm good, I'm golden, I'm okay. If it doesn't do that, then you take a loss. So trend is always a lagging indicator. Now, momentum, on the other hand, actually by its very nature, is a leading indication. Now, why do I say by nature? Think of a locomotive going down the tracks. That locomotive, and we've seen some of this in the news, unfortunately, lately, but when you pull the brake on that locomotive going down the track, in fact, I even saw some statistics on this on one of those news shows. They say if a train with 30 cars is going 60 miles an hour and they put the brakes on, it'll take it a mile to stop. So the trend, in other words, will continue after momentum comes out. And that's the key to momentum. Momentum is, by nature, a leading indication. And so, therefore, if we have momentum, even if that momentum comes out of the market, we should, and we normally do, get at least one more higher high, assuming a long trend. Lower low with a short trend, obviously. So momentum is absolutely key. I won't trade without it. I care more about momentum than I do trends, actually. Cycles, that's number 3. Cycles refer to the timing. When do I enter the market? And that's probably the most common issue that a lot of you talked about. Yes, Ron, it's true. Momentum and volume. Well, yes, volume is part of momentum, absolutely. That's kind of like the weight part of it. But you also have the acceleration aspect. And volume doesn't necessarily tell you acceleration, price acceleration. So it's really, they go together. I consider there's acceleration, and then there's the weight behind momentum would be the volume. But that's a good point. And then the third part, which I'm not getting into all these details because we have a limited time here today. Obviously, there's more behind all of this. But then where is that volume coming from? Is it coming from retailers? Sometimes a bunch of retailers will come in, and it can actually look like decent volume. Or is it coming from professional trading, institution, whales, all that kind of stuff? I look for block trades. I use time and sales. And I actually have a thing that will plot block trades on my volume histogram. And so block trades are essentially large orders, large single orders beyond what a retailer would make. And that lets you know there's professional participation there. And that's very, very important. So good point, though. I appreciate that. So cycles. Cycles is the timing of your entries and your exits. So I like to buy cycle lows and short cycle highs. We use this for both entries and for exits. The markets have a, they move in very different ways. There's all different types of price movements, obviously. Sometimes we just have very strong parabolic moves. But in general, the markets kind of move in waves. They kind of wiggle. Now, I'm not an Elliott wave technician. I've got a friend who is. He does very well. For me, Elliott wave's not for me personally, but again, he does well, and I've learned from him, and God bless him. He's a good guy. But for me, it's too subjective. So I do look at highs and lows, but just those that are mathematically measured. I don't believe in trying to fit every impulse move into a five-wave pattern, imposing that on the market. So, but what I do like to do is I like to get in at lows, the final cycle low before the market continues up, or the final cycle high before the market continues down, so that I don't get stopped out. And for example, an ABC complex retrace. I love to trade ABC complex retraces, but I want to get in on C, not on A. And that's the critical point. Support resistance. That's the fourth energy. Support resistance, very, very, very important. Most traders I know use support resistance in some way or another. Therefore, you should too. Sometimes people think, well, the stuff that a lot of people use, I don't want that. I want something really unique and different. You need both. It's not an either-or situation. You need both. You need to see what everybody else is seeing because it becomes a self-fulfilling prophecy. If a lot of people are seeing a certain support level or resistance level, then they're going to respond to that. They're going to buy into it, or they're going to take profits into it. They're going to look at it as a buying level or a selling level. And you want to see what the masses are seeing because they're going to react to it. On the other hand, yes, you do need to have some edge. You can't make money without an edge in the market, so you really need both. So for support resistance, primarily, I go way back to what my dad taught me and my first teacher outside of my dad taught me, and that's just looking at price levels. I mean, where has price been? Previous significant highs, previous significant lows. Now, you can get into floor trader pivots and Fibonacci and all that kind of stuff, and I do that too. I'll look at that. Especially like, for example, in the futures markets, floor trader pivots work very, very well, and that area high and low from market profile works very well. But you know what? It all comes down to everybody's not looking at all those things. Everybody, well, almost everybody, is looking at major significant highs and lows. So that's most important. And then also the fractal energy. Now, that's kind of a strange term here. What I'm really referring to is multiple time frames, or the energy of scale. So, if I'm looking at a daily chart for my trade setups, I'll also look at a weekly chart. And that weekly chart is the same market on a different scale, and that's what I call my energy of scale, or the fractal energy. Very common practice. Again, goes back all the way to the days of yore, but I do it a little differently than most people do, and if we have time, I'll show you how I do it differently. Okay, so those are the 5 energies. Now, I use instruments for those 5 energies. As I said, my trading is very methodical and objective. So I'm not going to just look at a chart and say, well, price is moving up, so it's an uptrend. No, that would be too discretionary for my taste, too subjective. So I have what I call instruments that measure these energies. Now, an instrument would be something like on a car, just to use a parallel example from real life. A car has a tachometer, it has a speedometer. We'll just use speedometer because that's very common. And it will tell you how fast that car is moving. Now, if you have a lot of experience driving, which most of us do, you could look out the window and say, oh, I'm probably going about 35 miles an hour. and you look at your speedometer and you're like, oh, I'm going 40 miles an hour. Okay, that's going to tell you exactly how fast you really are going. It gives you a number. And you could take that speedometer and you can put it in a Pinto, you can put it in a Ferrari, you could put it in a Rolls Royce, or you could put it in a Gremlin, and it's still going to tell you how fast that car is going, right? So I use instruments to measure these energies to give me actual values for each energy. So it's very objective. Now, what I call instruments, most people call indicators. And I understand that indicators are a controversial, or there's a controversy around them. Some people believe in them, some don't believe in them. Okay, I don't believe in them. And that's kind of ironic because I still use them. So what do I mean by I don't believe in them, but I still use them? So I use them, well, first of all, again, I'm always very literal about things. So what's an indicator? An indicator is just, it does what it says. It indicates. It doesn't tell. Otherwise, we call them tells, like in poker. They don't make you money. If they did, we'd call them money makers. But no, we call them indicators for a reason because they just indicate something. They point to something else. Now, price is not an indicator. Price is what is. Volume's not an indicator. Volume is just what is. Indicators are literally just mathematical formulas that people put together. And you take some numbers, you throw them in one side, and it runs through the calculation, and it spews out a value out the other side. And that value is then the energy, the value of that energy. Now, that alone does not make me any money. It's just a piece of information to consider. And you'll see how I use the information in order to make money. All right, so what do? I use simple things. I don't use any fancy proprietary indicators. Everything I use is just, standard on every charting platform out there I've ever seen. I've been through the whole proprietary indicator phase and spent way too much money on them, tens of thousands of dollars. And, some of them were pretty good. In fact, some were ingenious. But I just found that I could make just as much, if not more money, just using the common indicators that come free with every chart. So for trends, I use a 50-period simple moving average. That and the 200 simple moving average, which I also use, by the way, are probably the two most commonly used moving averages. Again, they're self-fulfilling prophecies. People use them, people watch them, and for that reason, I watch it too. So the 50-period simple moving average is the one I use for trend. Momentum, obviously, I've got a momentum indicator I use. Cycles, I use an oscillator. Support resistance, I already told you, previous cycle highs and lows, wave highs and lows for trader pivots. Fibonacci levels, things like that. The fractal energy, if I'm day trading, I use a 3-to-1 ratio. So if I was trading a 1-minute chart, I would also look at a 3-minute chart. If I'm using a 1,000-tick chart, I would use a 3,000-tick chart. Okay, as my fractal energy. The higher time frame would be my fractal energy. Okay. Why are we doing this? Why are we looking at these 5 energies? There's only one reason, and by the way, this is what all trading comes down to. Determining a probability scenario. Trading, there's no certainties. There's a famous saying in trading that the market can do anything at any time. And when you've been trading, as many decades as I have, you know that from experience. Everything looks perfect technically, and then all of a sudden news can come out, and wham! Another famous saying, news trumps technicals. Absolutely. In fact, it doesn't even have to be real news. It could be gossip. It could just be a rumor, and the market can go crazy. So there's no sure thing. Trading is always risky, and we never know what's going to happen on this particular trade, on any one given trade. Trading is about establishing a probability scenario over a large number of variables, and then when it doesn't work out, we've got our stops in, we hedge our positions, we manage our risk. Okay, so having said that, how do I personally determine a probability scenario? Here's how I do it. Very, very, very simple. At each potential entry point that I'm considering, I ask myself one question. How many of those 5 energies are aligned, being bullish or bearish, saying buy or saying sell? Based on that, I give each setup a score of 1 to 5. Obviously, the higher the score, the higher I consider the probability of success. I liken this to taking a trade to court. I need 5 independent witnesses to establish a preponderance of the evidence. So, think about a court case. The accused is sitting there, and he is charged with a crime. And 5 witnesses come in. And those 5 witnesses are his girlfriend, his brother, his best friend, his uncle, and his mommy. And they all say, yeah, he didn't do it. Okay. Well, that doesn't carry as much weight as if you had 5 witnesses who none of them knew the accused beforehand and none of them know each other. Those are independent witnesses. That would carry more weight. And that's what we've got here. That's what makes this work. These 5 energies, each one is non-correlated to the other 4. The operative word here is independent. So just as an example, like if you put 5 trend indicators on a chart, that means nothing. Because, yeah, you got the number 5, but you're still only measuring. It's not the indicator. You're only measuring one energy, see? So the number 1 does not establish a probability scenario. So these independent energies, what I mean by that is, for example, let's say price is moving up and the 50 MA is moving up. Okay, so the trend is up right now. That's great. But then you look down at momentum, the momentum instrument, and it's also moving up. Okay, well then those 2 energies are both bullish, so they are aligned. Does that mean we take the trade? Absolutely not. A 2 out of 5 is not a probability scenario. But you know what's interesting is a lot of times, and it's not uncommon, but sometimes people are surprised by this, a lot of times what happens is that price will be trending up and momentum will actually be trending south. It will actually be going down. And sometimes people wonder, well, how can you have price moving up when momentum is moving down? Well, it happens a lot. In that case, we would say those 2 energies are not aligned, and there's no way I would buy at that time. In fact, if we were extended in the trend, I might even fade the trend. Because that's something a lot of people are not going to see. They're not going to know. They don't know how to coordinate price action with momentum. Okay, so let's go through these 5 energies and go into a little more detail. So here we have energy number 1, trend. And trend I measure, as I said, by the 50-period simple moving average. It's the red line on the chart. And it's an intermediate trend indicator. It gives the overall direction of the market, which in this case is down. Now, some people say that trend is defined by higher highs and higher lows. And here in the blue ellipse, you see that I have a section mark where we do have a higher low, followed by a higher high. Is that the trend of the market? Well, the answer is really no, it's not. How do we know what the word trend means? Well, like any word, we go to the dictionary. And Webster's dictionary defines trend this way: to extend in a general direction. Now, the 2 operative words there are extend and general direction. So those 2 words imply that trend refers to a long-term move. And to translate that into the benefits of trading, that means that if we are good at trend trading, we will have a very good risk-to-reward ratio, because we will be in it for a big move. Now, in order to have an indicator that measures the trend, therefore you need a long-term indicator. Sometimes people say, well, gosh, why don't you, the 50 MA, it doesn't follow price very closely. And so why don't you use something like a 9-period EMA or something like that, a short-term one that follows price. If I don't need something that follows price, I can see what price action is doing. That would be useless. I want an indicator that is going to show me something different than price at certain times. By the way, any one of these indicators by themselves are absolutely useless. Let me throw that in there. Remember when I said I don't believe in indicators? That term, the way people say that, they believe in indicators. I believe in God. I don't believe in indicators, okay? So an indicator is what it is. It gives you the number, the value, and that number just is what it is. It doesn't mean it's going to make you any money, though. So I don't trust any one indicator. I would never rely on any one indicator. You can back test the 50 MA all you want. I'm going to tell you right now, it will not work. It will not make you money. So remember, the whole methodology is about waiting for the alignment of all 5 energies to say buy, or the alignment of all 5 energies to say short. And the reason that gives you a probability scenario is because the 5 energies are not correlated to each other. So that's the method. That's what makes us money. That's what gives us a probability scenario. Any one of these things, absolutely meaningless unto itself. Okay, having said that, actually what's interesting is when price gets above the 50 MA, as you can see there in the blue ellipse, that's actually a great shorting opportunity. And even though you have a higher low and a higher high, you're going to get a lot of amateurs who will trade that. They will think that that's a reverse head and shoulders. They think they should buy a higher low. That's typical retail behavior. So to trade, anytime you can identify retail behavior, by the way, I've got a whole webinar on that too sometime. If you get on my mailing list or whatever, I can send you the next time I do that webinar. How to determine retail behavior. Where are the retailers trading? One of my mentors called it, "Where's the loser?" It was almost like, "Where's Waldo?" And he had this game where he would, pull up charts and he'd say, "Okay, where's the loser trading? Where's the loser taking a trade?" And there's certain patterns that are very common for retailers or amateurs to take. And this is one of them, by the way. That's the reverse head and shoulders pattern. So let's see if I can bring up a drawing tool here. I haven't used this for so long. It'd be easier if I could out to some stuff, Yeah, it's been a long time since I've used Unambiguous. I'm not seeing where the drawing tool is. Okay, that's all right. Oh, wait. Nope, that's not it. Okay, so anyway, when we're above the 50 MA, that's actually what I call the rubber band trade. That is a price pattern in relation to the 50 MA that I trade. And the basic structure of it is price being above a downward angling 50 MA. And I've got a free video on that. I'd be happy to share with you guys the exact rules for that. So, but that's the basic structure of it. Okay? Now, next is momentum. Again, energy number 1, we can't trade by itself, but it just gives us an indication of the trend at that snapshot in time. So now, we're not going to trade yet, but we need the energy of momentum before we take a trade. So here we have, as you follow the arrows. Oh, you can see my pointer. Oh, okay, great. That's cool. That helps a lot. All right, so we've got a higher high, higher low, higher high, higher low. Now, so according to price pattern, we have a trend up. According to the 50 MA, we have a trend up at this snapshot in time, if this was the hard rate edge of the screen. All right, a lot of people are going to buy that. It's going to look like a real nice trend. That would be a huge mistake, as we can see, and I purposefully put the price action to the right of the chart so you could see that. Reason is that that's a weak trend. A strong trend is turned into a weak trend. How do you know? Momentum. Well, you can't see it on this chart, so let me take off the curtain here so you can see it. Here's the energy instrument. We have a lower, slightly lower high on momentum while we're making a significant higher high on price. And then that some people look for these divergences. Yeah, that's okay sometimes. Actually, I don't trade them. They're not really that significant. They don't work as well as they used to anymore. Here's what's more significant, though. Higher low on price, lower low on momentum. In fact, momentum actually goes down to 0. See how they have the values here? So momentum is none. It's 0. It's nilch. There's no momentum. So there's no strength here. That's how I would know this is okay to buy because momentum is strong. This one's not okay to buy. So again, this is a place where we could catch a lot of retail traders. Not that we're interested in making people lose money. We just know that they're going to be wrong. We're not trying to hurt anybody, but it's just a high probability thing to do. So an aggressive trade would be to fade here. That would be early. That would get you your best price. There's no momentum. It's a little risky, but it's not too bad. The highest probability short would be to wait for here. where now you've got confirmation of trend turning down. You've got a nice candlestick pattern, and momentum is below 0. Now, this is what always happens, though, almost always happens. The more confirmation you wait for, the worse entry you get. But the higher probability, the better the win-loss ratio. So worse risk-reward ratio, but better win-loss ratio. Energy number 3, cycles. This is the timing. Markets tend to wiggle up and wiggle down. And here's just a basic formation of the cycle indicator. That's not the whole thing, but that's just to illustrate the basic up-down movement of the market. Now, this is not really up-down. This is timing. This is timing. So, for example, here you see a cycle low. Here you see a cycle high, right? But look at price. It's just flat. It's just flat. There's no higher high here. And so, again, this is just a timing indicator. It's a timing indicator. Price may not go higher at all. And that's what happens here. So, again, we can't trade cycles by themselves. We would never buy every cycle low, never short every cycle high, because it doesn't give you any indication of range. Momentum gives you an indication of range. So, but we still use it in conjunction with the other energies. So by itself, useless, but with the other energies, useful at certain times. What's interesting to me is that a chart is a two-dimensional object. Right? There's only two things, price and time. And yet, very few traders I know actually use time in any significant way. And so if you don't, you're missing out on 50% of the information on the chart. And the famous trader W.D. Gann once said of the two, timing is actually more important than price. Well, I don't know. That's a controversial statement. I'm not necessarily saying I agree with it, but I am saying in a two-dimensional object, I certainly do want to take into consideration time. The fourth energy is support resistance. So here we'll just use an example of Fibonacci. Actually, we're going to use two examples. One's the Fibonacci. So we'll use this as our impulse move from this high to this low. Again, cannot be traded by itself. Why? Well, one example is, here's your 23.6 retracement level, and the market just slices right through it. So the question becomes, how do you determine which levels the market is likely to slice through and which levels are likely to hold and bounce off of? So, for time's sake, I see we're running a little behind on time, although we're going to be fine. We'll just take this example over here, the second arrow. So what would give us a high probability that this level is going to hold? Well, two things. Number one, more significantly, I like this high over here. I'm going to see that high. A lot of people will see that high. And then number two, it is the 50% retracement. And so we've got a cluster. Now, a lot of people make big deals out of support resistance clusters. And it does add to the probability. But sometimes you'll hear people say, well, a cluster is strong and stronger than a single one because there's two lines. And it's like a double thick ceiling. Well, lines don't mean anything. I'm telling you. It's not because there's lines there. It's what's happening with people. You know, some people, the reason there's a market logic, again, talking about market logic. There's a market logic why clusters actually are more significant, more likely to hold. And the reason is some market participants will see one resistance level and some will see another one. And some will see both. So you've just got more people, when you have a cluster, you got more people, more market participants seeing that level and responding to it, whether they're going to sell off of it or take profits into it or whatever. That's why clusters work, not because there's two lines there. Sorry, I get a little cynical with some of this stuff sometimes. Okay, so how would we determine that actually is going to hold and bounce off of? Well, here's what I would do. First of all, it is a cluster. Okay, so that's one piece of evidence, not enough to convict the trade. Number two, we've got a candlestick, engulfing candlestick pattern. That's fine. Again, not enough. Like Steve Nissen says, you've got to take candlesticks in the context of the overall chart context, or what does he say? Thinking of Alan Farley, he calls it the landscape. But the overall context of the chart, I think, is how he states it. Number three, okay, so we've got a cluster, we've got engulfing candlestick. high. Then number 3, the 50 MA is down. So we're actually looking, the direction of the market is down. The extended general direction is down. Yeah, we'll get short-term moves against it. And I love trading those little short-term moves against it. Because again, a lot of people will be caught looking to the long side here. So that's great. So this is the rubber band trade again. Price above a downward angling 50 MA. Cycle indicators turned over, meaning it's time for the market to go down. And momentum, well, momentum, when this market's been going down, this is the euro, I believe. No, this is probably the E-minis or something. Yeah. So when price has been going down, then momentum goes down, pulls far away from the zero line. Again, far from the zero line. When price goes up, there's very little strength. Now, momentum and support resistance go together because it takes strength to push through a support resistance level. There's no strength here. Weak momentum. Then when the market resumes down, it pulls farther away from the zero line again. So we've got 5 pieces of evidence. We've got a cluster resistance, we've got the engulfing candlestick, trend is down, cycle indicator turns over, and the move up is weak, and the moves down are strong. Energy number 5, the final energy. So this again is using multiple time frames. All right, so let's look at how we do this. So I don't trade a time frame this short anymore. They've changed the way that takes process through the exchange now, or through the computers, the servers. But I used to do a 100 tick chart of the NQ. Now I'll do 200 or 300. But anyway, the example's still the same. So we got a 100 tick chart over here. This would be our setup chart. And this would be our fractal energy chart. 3-to-1 ratio is what I use for day trading. So it's a 300 tick chart. This I consider my confirmation chart. It will either confirm the trade or it will filter out the trade. So let me show you how I do this. So price is kind of meandering here. There's nothing really significant going on. But it's above the 50 MA and then it meanders below the 50 MA. 50 MA is pretty flat. So, okay, well, we're looking to the short side, but nothing too convincing there. The 50 MA also provides resistance. Again, because it's such a powerful moving average, people do use it as kind of a line in the sand. We get an engulfing candlestick. Okay, well, that's nice. Again, not really anything too convincing. But the cycle indicator says it's time to go down. All right, and then momentum is below zero. This is actually an expansion-contraction trade. One of the cycles, of course, we have the cycle of up-down, but we also, by the way, when the cycle indicator is in the middle of the range like this, just wiggling around the middle, that's meaningless. Sometimes the market actually loses cycles. It skips cycles. But so we're waiting for more of an extreme move like this. So that's one of our things. And I love to trade out of contraction. That's another type of cycle in the market. Expansion, contraction. When the market contracts, kind of like, most people have heard of Bollinger Band squeezes. It's kind of that type of dynamic. And you can do it. That's one way you can identify them. But there's other ways as well. And I love doing them because they're usually very, very good reward trades. After contraction, then the market goes into expansion, meaning that it covers a wide range. So great risk-reward ratio on these things. I love them. They're fun. Momentum's below zero. We covered that. Now, before I can take this trade, I need to look over at the next higher time frame. And now here's what a lot of people do. They would look at the trend of the longer-term chart. And that's still viable. That's okay. That's okay. It's something to look at. 50 MA is angling down here. But what's more important to me is momentum. Momentum must be angling in the direction of my trade, or I will not take it. So this chart would filter out an otherwise good setup. Also, by the way, cycle is angling down. So here you got all three: trend, cycle, and momentum. Now, frankly, even if momentum was angling up, I'd still take the trade short, because I don't really care about trend on the longer-term time frame. All right, and why? The reason for that is because, well, there's a 3-to-1 ratio between these two charts, right? So one bar here, you got 3 bars over here. So this is a 3 times slower chart. And as I said before, trend is a lagging indicator. So I don't want to use a lagging indicator on a 3 times slower chart to confirm my trade. There's too much lag between the action here and here. It's like my first car that I had in Detroit. I was a kid in Detroit. I got my first job, and I had to drive, but I didn't have any money, so I got a junker. And I remember there was a lot of play in the steering wheel. So, I could turn it a certain number of degrees to the right or left, and the steering wheel would turn, but the tires wouldn't turn. The front tires wouldn't. So there was a play there, as they say. So the same thing here. If you use a lagging indicator on a 3 times slower chart, you're going to have a lot of play. But momentum is the potential leading indicator. It's faster than trend. So I'd rather use the faster indicator on the longer term chart, on the slower chart. So that's why. Okay, now let's put it all together, and then we'll finish up. So here's all I do. It's pretty darn simple. As I said, I don't make my trading complicated. I keep coming back to simplicity, and this is what I've settled on, and been doing this for 10 years now. So 5 energies, we take them in this order. Let me get my pointer here. So number 1, first of all, it's been going down, trending down for a while. So again, we're just talking about trend trading today. So before I take a trend, trend trade, I want to make sure it pops up above the 50 MA and get in early in a new trend. So number 1, trend. Always look at the energies in this order, pretty much just to keep my mind orderly. Okay, so yes, we are above the 50 MA. We're early in a new trend. That's the very first retrace in a new trend. That's the earliest we can get in. Okay, great. Is that enough? Am I going to buy? It's not enough to make a decision yet. Number 2, is it a strong trend or a weak trend? I look to the energy of momentum. And there's your zero line, and momentum is well above the zero line. Therefore, we consider it a strong trend. Okay, great. Number 3, cycle low for timing. Is there a timing indicator? And yes, the time is right. We wait for this to turn green, come back up, and that's great. So the time is right. We're not going to worry about getting, stopped out on an ABC complex retrace or something like that. Number 4, since we're buying a retrace, we want the impulse move to be strong. That's your momentum. And the retrace to be weak. And the correction to be weak. So it is, but then we need something for it to bounce off of. And that kind of proves that the correction is weak. So if it bounces off of support, which is this red line, that's the 50% retracement level. And it does. It bounces back up. And then finally, number 5, I won't take the trade unless momentum on the higher time frame, the fractal energy, is supporting the trade. Now notice here we have an example where the 50 MA is angling down, but we're looking to go long. Okay, I don't give a mouse's left patootie what the 50 MA is doing over here. So, and here's an example too where he said trend can be down and momentum can be up. Momentum's up and it's at a nice sharp angle. By the way, if momentum was kind of flat, or maybe turning up a little bit but not much, but just visually it looked kind of flat or I wasn't sure, I have a rule. One of my rules in my methodology is if I'm not absolutely positively clear that this trade is valid and meets all my rules, I just keep my powder dry. I stay out of the trade. That's a general rule. Everything has to be very, very clear. If I have to think about it, and the way I kind of measure myself on that or catch myself on it is if I have to think about it too hard. I'm saying, well, let's see, it looks like momentum's up. I don't know. It's close. And, I have to change the scale and measure the pixels and all that kind of stuff. No. Don't take the trade. Keep your powder dry and wait for another setup that's just perfectly clear. So in this one, 50 MA is angling, or the momentum's angling up beautifully. Also, cycle is moving up. And so that's a 5 out of 5 trade, and I would take that any day of the week. In fact, I do. All right, so let's summarize here, and we're just running over a couple minutes, but I got the okay on that. So all I'm doing is I'm waiting for the alignment of the 5 energies to put the odds on your side. And here's really how simple my trading is. I'm looking for a trend, number 1, energy number 1, that is strong, energy number 2. Then I wait for the right time with the cycle indicator and make sure I have support at my back or resistance, depending on whether I'm going long or short, obviously. And then I'll only trade if energy number 5 is there. It's confirmed by momentum on the longer term time frame. It's very robust, very adaptable. I use the same 5 energy method, trading stocks, commodities, options, currencies, and futures. I don't teach options directly, but I do help option traders, and I do train option traders. The way I do that, and I trade options, by the way. I just don't teach option strategies. The way that I help option traders is by helping them to read the market, or the chart of the underlying market they're trading. I don't know how. I find this with a lot of option traders for some reason. It's like they know all their option strategies, but some of them really don't know how to read the chart of the underlying instrument they're trading. And I don't know how you can trade options without being able to do that. To me, that's just crazy. I don't know. It doesn't work for me. So that's how I help option traders. Okay. Also, it works for a variety of time frames, and I trade all of these. I invest with my not a big investor, but I do investing in my retirement accounts. And the only difference there is with investing, I will look at the fundamentals of the company as well. But I still use the 5 energy method for the timing of when to enter that stock or that market. So if I like everything about the company, I'll put it on a watch list, but then I'll wait for the technical setup to actually take my position. I do it for swing trading, I do it for day trading, and I use the same 5 energy method for all of this stuff. It's very simple, it's very objective, it's pretty much just counting to 4. And like I say, it's robust and adaptable for all these markets because it's just like that speedometer on your car. All we're doing is we're measuring, we're actually in a way, if you can think of it this way, put a chart up that's blank, and then you put your instruments on there, like the instruments on a dashboard of a car or the cockpit of a plane. Still no market, no time frame. You're just putting your instruments on the chart. That's your dashboard. Then you put your market up there, and then you put your time interval. And these instruments will measure those 5 energies of whatever market you put on there and whatever time interval you put on there. So not selling anything today. Got nothing to sell. So put your put your wallets away and your purses away. But I am happy to answer any questions. If you want to send me any questions via email, feel free. Barry@topdogtrading.com is my email address. And I'm even giving you away one of my courses today, my free 5-day video correspondence course. It's a little mini course. It has 5 video lessons, and each video is about 20 minutes long. And at the end of each video, there's actually an interactive quiz, so that you can take the quiz right on the video and get feedback as to whether your answers are right or wrong. Nobody else will see it except you. Also, in those videos on day 4, the 4th video, I give you that rubber band trade that I was mentioning. But I go into more detail today. I just showed you the basic structure. In the video, I give you all the rules to the rubber band trade. So you'll get that for free. And also, if you're interested, next week I'm going to be doing another webinar. It's going to be different than this one. The one next week is called How to Time Your Entries with Swiss Clock Precision. And it's also free. And I'm giving away my personal cycle indicator at that webinar. And then not only will I give you the indicator, but I will also give you a tutorial on how to trade it. Remember, we don't trade every cycle high or low. We look for certain setups, certain patterns on the indicator. Now, again, I don't use any proprietary indicators, so when I say I'm giving you my personal cycle indicator, it's actually a modification of an indicator, a very, very common indicator that's already on your charts. I've seen it on every charting platform out there, so it's one of the most common indicators there are. But we make changes to it, and I'll show you how to make those changes. And then, more important than that, that would still be useless, is how to trade it, the patterns we look on it. Just like price can have patterns, head and shoulders, double tops, wedges, triangles, all that kind of stuff. Indicators also can have patterns. And there's 6 patterns that I trade on that cycle indicator. So if you're interested in this, it's all free, all of it. just go to the website you see there. We shortened the URL, bit.ly.com /CTU trading. And let's see, maybe I can type this in here. Oh, there we go. James is on top of it. Page not found. Let me try. Thank you for telling me that, because we don't want... Nope, it opened for me. I got it. Okay, James, I'm not sure why it's not found for you. I just clicked on the very link you typed in to the chat box, and it popped up for me. So, don't know what to tell you about that. It just worked for me. Well, I'm checking the spelling, but actually, like I said, I just clicked on your link and it worked. So, if the link doesn't work for you for some reason, feel free to send me an email at barry@topdogtrading.com, and I will send you the actual URL. Obviously, we're doing this for tracking so that we, can see who came in through the CTU. And okay, Jesse said it worked for him. All right. Okay, so some are seeing it, some aren't. I have no idea why that would be. I'm not a tech guy at all. At all. So I really don't know why. Like I said, it worked for me, it worked for Jesse, it worked for several people. Some it is, some it isn't. But yeah, try maybe a different browser. Yeah, copy and paste it into the browser. That's a good idea. That's a very good idea. Or try a different browser or something. Or you can make life easy and just send me an email at barry@topdogtraining.com. Ask for the direct link to the 5-day video correspondence course. Or just say 5-day course. I don't know what you mean. And I'll send you the direct link so you don't have to go through bit.ly.com. Okay. Just ask for the 5-day course. Lori got it. Okay. Brad, where can we get access to what you have delivered today to review after the webinar? Oh, yeah. Oh, here's a key. Lori said she left out the http://. Oh, that's interesting. All right. Thank you for sharing that, Lori. So maybe try that. Start with bit.ly.com instead of the HTTP. Maybe that'll help. I don't know. Was this webinar recorded today? I'm not sure. You have to ask the powers that be. And they can tell you it's their platform, so they would have to record it. Yes, they did record it. Okay. So if you want to get a recording, you can request that from them. Yeah, no, there's no www on this one, on that link. Alrighty, well, we've run over a little bit. I don't want to keep anybody late. Respect your schedules. I know we're all busy. Respect your time. So I'll just say that if you do have any questions, feel free to send me an email. You see it up there, barry@topdogtrading.com. And no, you don't have to buy anything. You don't have to put in any credit card or anything like that to get this 5-day free video correspondence course. When I say it's free, it's free. No credit card required to access it. Yep. Well, you're very welcome. Thank you. Okay, so the recording will be available on their YouTube channel, on CTU's YouTube channel, in a few days. Great. All right, everybody, you're very welcome. Thanks, Wayne and Lewis and Brad and Lori and everybody. It was my pleasure to be here. I hope you enjoyed the presentation, and look forward to hearing from you.